Welcome to the deep dive. Sometimes the companies we look at, well, they aren't your typical operating businesses. They're more like high-stakes construction plays, all wrapped up in some pretty complex financial maneuvers. And often, like today, they're operating in, let's say, challenging economic conditions, hyperinflation, for instance.
That's exactly the world we're stepping into today. We're really digging into Marmaris, Altinyunus, Touristic, Tesisler Yin. You'll see it as Mail AllQ or Maros. We're working mainly from their activity report and the summary financial statements for the first 9 months of 2025. And like you said, this isn't just about reading the numbers off a page. It's about figuring out a company's strategy, how they're trying to build this massive future asset while, dodging some serious legal and economic curveball.
Right. So our mission here is to take these sources, which are frankly pretty technical, but absolutely vital if you follow the Turkish hospitality sector or these kinds of development companies, and translate it all into something clear, something actionable for you, the individual investor. We need to look past just the headline figures and really grasp the risk and reward game MLT is playing right now.
And we absolutely have to start with the context. It shapes every single number we'll talk about. These financials aren't standard, not by a long shot. They're prepared under Turkish accounting standard, TMS 29. That means adjustments for high inflation. For this period, the 3-year cumulative inflation rate they used was, well, staggering, 220%.
Wow, 220%.
Yeah. So every number we see reflects purchasing power as of September 30th, 2025. If you see a number that looks kind of flat compared to last year, that means its real economic value actually held up, despite, the currency taking a beating. It's really the only way to see the true economic picture. But you really have to keep that inflation lens on the whole time. It changes how you interpret everything.
Okay, definitely. Let's unpack the company itself first then. Got to lay the groundwork before we dive into this huge project they're juggling.
All right. So Melalt, it trades on the Borsa Istanbul main market, ticker's Maris. Fundamentally, it's structured more like an asset management and development company right now. Its whole focus has shifted towards one single massive capital project.
So what are the core assets? What defines what Malti actually is today?
Okay, there are two main pieces. First, and this is the only thing bringing in cash right now, is the Mayor's Hotel in Marmaris. Big place, over 1,000 beds. But crucially, Melalt doesn't run it. They leased it out to a company called MP Hotel Management.
And the lease structure there, that's kind of Malti's safety net at the moment, isn't it?
Oh, absolutely vital. The lease got extended way back in 2018, runs until May 2035. And here's the key financial point. The entire rent for that whole period, we're talking 20 million US dollars, plus the standard VAT or KDV, was collected up front years ago. So that dictates MLT's current income stream. It's fixed, it's non-operational revenue.
Okay, now that's really important, especially given what's happening with the tenant. MP Hotel Management, they entered Concordato, right? Some kind of creditor protection process. They got a 1-year moratorium until November 2025. So if the rent's already paid, why do MLT or, why should we care if the tenant is struggling?
That's a really good question. It's necessary to ask. Well, yeah, the immediate cash flow from rent isn't affected. The risk isn't totally gone, right? MLT still has counterparty risk. They need the tenant to stick to the whole contract, things like maintenance, upkeep, operational standards, how they hand the hotel back eventually. If the tenant's in financial distress, you start worrying if they can actually maintain a luxury property properly. So management was smart. They got a renewed guarantee check from the tenant. It shows MLT's actively managing those non-money risks, making sure they have legal options if the tenant slips up on operations or maintenance, even though the rent money itself is safe.
Oh, okay, that makes sense. You've got to protect the long-term value of the building itself, not just the rent check. All right, let's move to the second asset, the big one, the one that dictates everything else. The Divan Talia Hotel in Antalya.
The Talia Hotel. Yeah, that's basically the whole story for Malti right now. It's been shut since 2013. They knocked it down completely, and now it's this huge, very visible rebuilding project. Right now, that asset is just pure capital expenditure, a giant sponge soaking up billions of lira. The plan is for it to become the main revenue driver, but not until 2026. So for now, MLT is essentially, a massive construction fund run by the Kas Group.
Let's talk about that cost connection then.
Yeah.
Looking at the capital and ownership structure that tells us who's really in charge, who's holding the risk here.
Definitely. The ownership is dominated by the Kos conglomerate. That's where MALT gets its stability, its access to capital. The issued capital looks tiny on paper, only about 7 million TL nominal value. But Kos Holding Adesh owns 50.58%. Then you add in Family Danshmanlik, another related entity, with almost 23%, plus other Kos family members with nearly 3%. You're looking at the controlling group holding over 76% of the shares.
So almost three-quarters is locked up tight. For us, the public investors, the actual free float, the Fili Dolishundaki Pay Orana, is just under 23.5% as of September 2025. That means the stock price is probably heavily influenced by what the parent group decides and does, right? Less risk of hostile takeovers or sudden strategy shifts.
Exactly. We saw a little signal of that commitment recently. Back in June 2025, Coase Holding bought another small slice, just 0.52% of the shares internally, cost them about 23.5 million TL. It's small percentage-wise, but it reinforces the parent's grip, signals they're sticking with it, even through all the construction headaches and legal fights. The direction is set.
Okay, and the board reflects that control too, doesn't it? The corporate governance side.
Yeah, the board's packed with heavy hitters, ensures tight oversight. 6 members. Semahat Savi Marcel is the chair. Yiloduram Ali Kos is the vice chair. These are top leaders from the wider Coase Group, directly involved in steering the Talya project and managing its risks.
And I always like to check the gender diversity numbers on boards.
Good point. There are 2 women on the 6-member board, Semahat Savi Marcel, the chair, and Didem Gordon. So that's 33.3% diversity. Pretty strong figure, showing they're paying attention to governance principles there. And it's worth noting Didem Gordon chairs both the audit and corporate governance committees, which are critical oversight roles.
Okay, let's shift gears to personnel. This is where the company profile gets really unusual, right? Tiny headcount managing these massive assets.
It's the definition of lean. Or maybe high leverage is a better word. As of September 30th, 2025, just 15 employees. That's up slightly from 13 at the end of 2024. This tiny staff number just screams non-operational. They're not renting hotels day to day. They're managing contracts, finance, legal defenses for this multi-billion lira development.
And that probably explains the executive compensation figure, which looks huge on the surface. Total pay and benefits for the board and senior execs for the first 9 months was what? Nearly 5.5 million TL for just 15 people. Even adjusted for inflation, that feels like a lot.
Yeah, but you have to reframe what that cost represents. It's not really a cost of labor in the usual sense. It's the cost of elite project management and crisis control. You're paying a very small, very senior team to steer a $100 million plus project through hyperinflation while fighting off major legal challenges in high courts. The high pay reflects the need for top-tier legal, financial, and construction management talent to navigate all these risks and make sure billions in capital get deployed properly. It's more like a strategic expense to protect the future asset, not your typical payroll cost.
Got it. So MLT is this tightly controlled entity, leveraging the prepaid rent from the mayor's hotel to fund a small but very expensive executive team. And that team is laser-focused on one thing, getting the Divan-Talya project built, which brings us neatly to the core strategy.
Right, the Divan-Talya Hotel project. This is MLT's entire value proposition for the foreseeable future. Everything they do, cash flow, legal filings, it all points towards getting this hotel finished and opened.
And the first big news on that front during this period was the budget revision, a huge jump. Original estimate back in 2023 was $80 million USD plus VAT. Then in June 2025, they revised it up to $100 million USD plus VAT. That's a 25% increase. That's substantial.
It's a massive revision, yeah. And it tells us a couple of things. One, how severe the external pressures are. And 2, that management is prioritizing quality, maybe over strict cost control. The report cites 3 main reasons. First, that unexpected 7-month construction halt because of the legal stuff. That added delay costs for mobilization expenses, very expensive.
7 months is forever in construction, especially when inflation's running at, what, 220% cumulative?
Precisely. Which leads to the second reason, just relentless cost inflation across the board. Materials, skilled labor, specialized services, everything got more expensive. And third, they actually chose to add some improvements to the project scope to make sure the finished hotel really hits the mark for its target market and profitability. Basically, they decided that trying to cut corners just to stick to the old $80 million budget was riskier than spending more now to guarantee the finished asset can actually generate the high returns needed to justify this huge investment. It's a strategic bet on long-term value.
So where does this $100 million project actually stand physically as of September 2025?
Progress looks pretty solid, but there are still key parts to finish. Overall completion was reported at 63%. The main structure, the Kaaba Ainshot or rough construction, that's nearly done. Architectural work, the facade, that's over 70% complete, but some big pieces are still lagging. The Congress Center work is just starting. And things like the beach renovation haven't even begun yet. Those could be potential bottlenecks for the schedule.
And the big date everyone's watching is the target launch.
Q2 2026. That's the magic date. It's the single most critical non-financial factor for MLT right now. If they hit that target, all those billions sitting as construction in progress suddenly become a revenue-generating luxury hotel. The whole company's financial profile changes overnight. Any slip past Q2 2026 means more inflation exposure, delayed returns. It gets tricky fast. Okay, let's tackle how they plugged that funding gap. That $20 million cost increase created a, $50 million total funding need that had to be sorted out fast.
Right.
And this is where having co-sitting control moves from being just an ownership fact to a critical strategic tool. The financing plan has two main parts, and it really shows the parent company stepping up. The biggest chunk is that targeted capital injection, the $40 million equivalent. Correct. That's going to be covered by a rights issue, a specific type of capital increase. But it's allocated exclusively to Coase Holding-ish. It's called a tassisli satish, an allocated sale. Basically, Coase Holding injects roughly 1.6 billion lira, give or take, based on the exchange rate, directly into MALT's equity. They applied to the SPK, the Capital Markets Board, for approval back in July 2025.
Let's pause on that tassisli satish, because for minority shareholders like the public float, this is kind of a double-edged sword, isn't it? Is there a downside for them here?
That's a really important angle. On the plus side, it's the ultimate safety net. Coase Holding is basically saying, we guarantee this $100 million project gets finished. We'll put in the cash. That secures the future asset value for everyone. But the downside is, relative ownership dilution. If the new shares are only sold to the parent, then existing minority shareholders see their percentage stake in the company shrink slightly, even if the total value of the company or the asset is going up because the funding is secured. Management basically chose guaranteed completion funded by the parent over, say, a general rights issue, where minority holders might have struggled to pony up their share of the cash.
A tough trade-off, maybe a necessary one for survival. Okay, and how did they plan to cover the rest of the financing need?
For the remainder, MALT got approval in September 2025 to issue bonds or financial bills, up to 400 million TL worth within a one-year window. So this mixed big equity injection from the parent plus some strategic external debt means the full $100 billion budget is now essentially secured. That removes the immediate financial risk of the project running out of steam.
All right, funding secured. But before that, the whole project was dangling by a legal thread for months, wasn't it? Let's talk about those legal hurdles.
Oh, it was a genuine crisis moment. The main fight was over the building permits, the zoning plans, the 15,000 and 11,000 scale plans. Back in July 2024, an Antalya administrative court actually ruled in favor of the group challenging the plans. They accepted the request to cancel the 11,000 plan and the construction license. That ruling was disastrous. It forced that 7-month construction halt we talked about, ordered by the local municipality.
7 months with everything stopped. That must have been the point where MLT's future felt most uncertain. How did they turn that around?
They appealed immediately, took it up to the Konya Regional Administrative Court, the Konya Bolje Adair Makamezi. That's a higher administrative court level. And in February 2025, they got the big win. The Konya court accepted MALT's appeal. Crucially, it lifted that initial negative court decision. That action instantly made the 11,000 plan and the building permit valid again. Construction could restart. They essentially won back their right to build.
Okay, sounds like a clear victory. Yeah. Remove the immediate threat. But we need to be precise here. The legal fight isn't completely definitively over yet, is it? There's still some uncertainty.
No, exactly. It lingers, which is why investors need to keep watching. The plaintiff, the group that originally challenged the permits, they've appealed the Konya court's decision again. This time, it's gone to the Danishte, Turkey's Council of State. That's the highest administrative court. So while construction is moving ahead right now under a permit that is currently valid, there's still a chance, maybe small, but still a chance, that the Danishte could overturn the Konya decision.
And if the Danishte did rule against MALT, what would that mean? What's the risk?
The worst case. Catastrophic delay, maybe even being forced to change the project design. If the highest court says the permit is invalid after all, MLT could face another construction freeze, or maybe have to make drastic, expensive changes to the plans. And that would be after they've already sunk, close to $100 million into it. But the fact they won at the regional court and are confidently building suggests they feel pretty good about their legal standing. Still, that final ruling hasn't happened yet. The risk remains.
Okay. Before we get into the financials, let's quickly loop back to the mayor's hotel, the leased one, and the tenant's concordado. You said the rent's safe, but what else is management doing to protect MLT?
Right, so that definite moratorium for MP Hotel Management runs until November 2025. Even with the rent prepaid, MLT isn't just sitting back. They're actively monitoring all the contract terms. Getting that renewed guarantee check was key. It confirms that if MP Hotel's financial troubles cause any breach of contract beyond just rent payment, MAT has a secured way to seek damages without getting bogged down in complex legal collection processes. It just shows they're being careful about managing that counterparty risk.
Okay, so it paints a picture of a company performing this incredibly complex balancing act, legal, financial, all under the shadow of hyperinflation. Let's dive into the financial performance now. This is where that inflation accounting really takes center stage, isn't it?
Absolutely. As we get into the numbers, you've got to constantly remember that 220% cumulative inflation rate. Every figure is restated to September 30, 2025 purchasing power. It gives us a view of the economic reality, not just the nominal lira flowing around.
And remind us again about TMS 29, especially how it treats monetary versus non-monetary assets. That's key here, right?
Yeah. It's crucial. Under TMS 29, monetary assets are things with a fixed nominal value like cash or receivables fixed in lira. In hyperinflation, the purchasing power of these just evaporates. That leads to what's called the net monetary position loss, or parasol kayıp. Non-monetary assets, though, things like property, equipment, the construction project itself, they tend to hold their real value. They get revalued upwards in the accounts.
So if you're holding cash to fund a multi-year project, it's like trying to pay your bills with an ice cube that's melting faster and faster.
Perfect analogy. The cost of delay, the cost of just holding cash, it's huge. MALT's strategy is basically to convert that vulnerable, melting cash into the non-monetary asset, the Divan Palya building, as quickly as possible. That protects the capital's purchasing power. And weirdly, under this accounting standard, it can actually generate an accounting gain.
Okay, let's start at the top of the income statement. Zero, sales revenue.
Sales revenue for the first 9 months of 2025 was 35.76 million TL. That's barely up from 35.03 million TL in the same period of 2024 after adjusting for inflation. That flat line is exactly what we'd expect. The revenue is fixed. It just comes from recognizing that prepaid mayor's hotel rent over time. Confirms there's no operational growth happening right now.
Okay, flat revenue. But then Brutcar gross profit jumped significantly in real terms, from about 8.6 million TL in 2024 to 15.2 million TL in 2025. That's like a 77% real increase.
Yeah, that signals they're being really efficient in managing that mayor's asset. Since the revenue is fixed and high and MALT isn't paying the hotel's day-to-day running costs, their direct costs related to just owning the investment property like amortization seem to be managed very tightly. That's leading to a much stronger real gross margin.
But here's where it gets really confusing if you just glance at the summary numbers. Despite that nice gross profit gain, the İHSAS Faaliyet Zara, the operating loss, actually got worse. It widened from about negative 5.5 million TL in 2024 to negative 11 million TL in 2025. So non-revenue costs are soaring in real terms. What's driving that?
They are. And this is the direct cost of actually doing the $100 million strategy and fighting the legal battles. The main driver is a massive jump in general administrative expenses, G&A. They surged by a real 42% from about 18.7 million TL to 26.4 million TL. We need to unpack what's in there.
If they only have 15 employees, where's all that G&A money going?
Well, a chunk is the higher cost for those elite personnel I talked about. Personnel expenses went from 8 million to 11 million TL. But the biggest jump seems to be in external professional services. That G&A line includes ballooning costs for consulting, audit, advisory fees. Think about the context. They just fought and won major legal cases up to the regional court level. They're managing a $100 million construction budget with big cost overruns. They're prepping complex filings for a capital increase with the regulator, the SPK. These all require expensive specialized help, so that bigger operating loss. It's really a managed strategic cost. The cost of development and legal defense, not a sign of an inefficient hotel operation.
Okay, so the operations are technically losing money, but it's strategic spending. But then we get to the bottom line, the net period result, and it's this absolutely massive swing from a net loss of nearly 192 million TL in 2024 to a net profit of almost 15 million TL in 2025. That profit feels like a total contradiction after the operating loss. How does that happen?
That profit is almost entirely an accounting result driven by inflation management. Specifically, it's about the change in that parasol kayıp, the net monetary position loss. See, in 2024, MALT held a lot more net monetary assets, basically, vulnerable cash. So they reported a huge monetary loss of about 482 million TL just from the purchasing power evaporating.
And what changed in 2025 to flip that?
They executed the strategy. They spent the cash monetary asset really fast on building the hotel non-monetary asset. That conversion dramatically reduced their exposure to inflation's bite. So the monetary loss plummeted to only about 96 million TL in the first 9 months of 2025. That reduction, nearly 386 million TL less in monetary loss compared to 2024, is what single-handedly wipes out the operating loss and leaves room for that final net profit of 14.8 million TL.
Right. That's the critical connection. The net profit isn't telling you the business is suddenly profitable in the usual sense. It's telling you the company got much better at managing its balance sheet to shield capital from inflation, which leads us straight into looking at that balance sheet and liquidity.
Exactly. Total assets look strong, up to 3.91 billion TL, show the value accumulating in the project. And the composition of those assets tells the spending story very clearly. Cash and cash equivalents, they plunged. From 566 million TL at the end of 2024 down to just 149.4 million TL by September 2025.
That's an outflow of over 400 million TL. That's the melting ice cube being poured into the concrete foundations of the Talia Hotel.
Precisely. And that cash outflow directly funded the massive increase we see in Madi Duranvar Liklar property, plant, and equipment. That jumped from 2.37 billion TL up to 3.04 billion TL. If you look at the construction in progresses line within that, it shows 671.2 million TL was spent and capitalized during these 9 months of 2025.
I noticed that 671 million spending in 9 months of 2025 is actually quite a bit lower than the 1.18 billion spent in the same period back in 2024.
Good catch. That lower spending number is the direct financial echo of that 7-month construction halt we discussed. The legal challenge literally paused the spending, the capital deployment. It shows how those legal risks immediately translate into operational slowdowns and financial drag.
Okay, let's flip to the liability side. Short-term liabilities jumped up really sharply, from about 104 million TL to nearly 368 million TL. That seems like a big spike for a company supposedly backed by Coase.
This is probably the most fascinating piece of MALT's liquidity management, how they use related party financing as a sort of operational cushion. That spike in short-term liabilities, it's almost entirely driven by a huge increase in Takari Borslar trade payables owed to related parties. That line item skyrocketed from 51 million TL to over 300 million TL.
And these are mostly payables owed to Erkenschott, right? The main construction contractor, which is also a Coase Group company.
It's exactly right. Erkenschott billed MALT nearly 600 million TL for construction work during this period. But instead of MLT paying that cash immediately, Erkenschott is essentially extending them credit. They're letting the payable build up. Erkenschott is effectively bankrolling the construction costs on a short-term basis, acting like a massive, probably interest-free operational float. It shows an incredible level of internal support and financing capability within the Kuckens Group, making sure construction doesn't stop just because cash is temporarily tight between funding rounds.
That related party financing is key then, because despite all this massive spending, MLT still technically has a net cash position, right? And importantly, no external bank loans or financial debt.
That zero financial debt figure is a major point of strength. They're funding a $100 million project entirely through internal equity, well, planned equity, and these internal operational payables. They're avoiding high-interest commercial debt, which would be absolutely crippling in this kind of inflationary environment. Total equity is still very solid at 3.15 billion TL, reflecting the real inflation-adjusted value of the assets being built.
Okay, let's wrap up the financials with the cash flow statement. Help me connect the dots here. We know the operating result, the Isas Faliet Zara'a, is a loss. So how can the net cash flow from operating activities be strongly positive? It swung from negative 258 million TL in 2024 to positive 345 million TL in 2025. That seems totally backwards compared to the income statement. That's the magic. Or maybe the complexity, hidden in the working capital changes, which you find detailed further down. That positive operating cash flow, it's almost entirely due to non-cash items, and crucially, that massive increase in trade payables we just talked about. Think about it. Erkenschott does 600 million TL worth of work. Akın records that as an expense, contributing to the operating loss on the income statement. But because Akın doesn't pay the cash immediately, and instead lets the payable owed to Erkenschott increase on the balance sheet, that increase in payables counts as a positive adjustment to cash flow from operations.
So the positive operating cash flow isn't coming from running hotels well. It's coming from the builder, a sister company, strategically letting them delay payment. Exactly. The internal financing from Erkenschott is acting as a temporary liquidity boost reflected in the operating cash flow. And then cash flow from investing activities confirms where that borrowed liquidity went. A big outflow of 671.2 million TL going straight into building the fixed assets, the Talia project. It's this intricate dance, showing the whole Coase Group working together to make sure Alti has the cash it needs, when it needs it, to keep the project moving, even if it means using accounts payable like a short-term internal loan.
This whole deep dive into the financials really hammers home that MAP isn't really a hotel stock right now. It's much more like a highly managed development fund. The financial results are all about strategic spending, managing inflation accounting quirks, and relying heavily on the support of the parent group.
Right. So let's try and distill all this complexity into some clear takeaways for you, the investor. Given the huge risks, the massive capital involved, what does it all mean?
Well, starting with the financial ratios, they really highlight that development focus, don't they?
They do. Key ratios like return on assets, ROA, and return on equity, ROE. Yeah, they technically turn positive in the first 9 months of 2025, but just barely.
Yeah.
We're talking 0.0003 for ROA and 0.004 for ROE. Now, that's better than the big negative numbers from 2024, sure. But these incredibly low positive figures just confirm what we discussed. That net profit result, it's almost entirely non-operational, driven by accounting for inflation. It reinforces the main investment idea. You're not buying into current operational success. You're investing in the potential future value of that completed Antalya hotel.
And what about external validation? What does the credit rating tell us about how the market views this high-wire act?
The credit rating from JCR of Russia is interesting. They give MALT a strong long-term national note rating, AA+ TR. That clearly reflects the market seeing the Coast Group's backing as a huge safety factor. However, that strong rating comes with a negative outlook. That combination is really telling. The negative outlook signals caution. It's likely because of the sheer scale of this ongoing $100 million project, the risks around execution and potential further cost overruns, and importantly, that remaining legal uncertainty with the Donashte appeal still pending. So the market sees the safety net, but it's also wary about the difficulty of the jump MALT is trying to make.
Okay. And for anyone hoping for quick cash returns like dividends, the policy seems pretty clear on that.
Crystal clear. Don't expect any cash dividends anytime soon, nor should you really. The official policy prioritizes using any available funds, first to chip away at those massive accumulated past losses over £1 billion worth. And second, and most importantly, to keep financing the ongoing investment in rebuilding the Talya Hotel. Every spare lira is going into getting that asset finished and strengthening the balance sheet.
And to make room for that huge planned cash injection from Coast Holding, they had to adjust the company's capital structure rules, right?
Yeah, they took the necessary step of increasing the Sermaye Tavani, the registered capital ceiling. It was boosted massively from 50 million TL up to 2 billion TL. And that ceiling is now valid until the end of 2029. That was a crucial regulatory move. It makes sure the company's legal framework is ready to handle that planned $40 million allocated rights issue from Coast Holding, so the funding can flow smoothly once the SPK gives the final green light.
I always find the dipnotler, the footnotes and detailed disclosures, offer some really telling insights, especially around management's thinking on future taxes.
Oh yeah, that's a great example of their prudence, maybe even conservatism.
Yeah.
Alan Alti actually has significant potential tax benefits, waiting specifically. 256 million TL in investment tax reduction rights linked directly to the Divantalya project. But they have deliberately chosen not to record these as a deferred tax asset on their balance sheet yet. Why? Because accounting rules say you can only book that asset if you have sufficient evidence of sustained future taxable profits to use those credits against. Given the years of losses while the hotel was closed, management is basically saying, we can't be certain enough about future profits yet. They're refusing to count that benefit until they're absolutely sure they can use it. It speaks volumes about how cautiously they're forecasting the path back to profitability.
And finally, those footnotes also really detail the heavy reliance on the wider Kaki ecosystem for operations, don't they?
They absolutely confirm that group effort we've been tracing. It's not just Arkanshot handling the massive construction billing, though that 598 million TL in 9 months is huge. Other Cook's companies provide key services too, like Zur handles centralized procurement or admin. Cook System does IT support. This deep internal reliance ensures the project keeps moving. It allows for that strategic use of payables to manage cash flow, and it means the project benefits from the group's existing expertise and scale. It reduces dependence on potentially less reliable external suppliers. Okay, so let's try to pull it all together. We've got the cost financial backstop, this massive $100 million development budget, a crucial legal win but still some lingering risk, the weird effects of hyperinflation accounting, masking operational losses, and that all-important Q2 2026 deadline. What's the core message here?
I think the bottom line is MALT is a classic high-conviction development play. Its value, its future performance, it all boils down to execution right now. They've managed to secure the funding. They won the critical legal battle at the regional court, which cleared the path to restart construction. The cost backing drastically reduces the risk of them running out of money, but the key variables are still there. Can they manage the project effectively enough to hit that Q2 2026 opening date without more major delays or cost blowouts? And what's the final outcome of that Danish Day appeal? Essentially, if you invest now, you're betting on the successful transformation of billions of lire worth of concrete and steel into a profitable, cash-generating luxury hotel starting next year.
And here's where it gets really interesting, right? That turnaround, it hinges completely on hitting that Q2 2026 date and then actually running that new $100 million asset profitably. If they open on time, the whole narrative shifts. MAL goes from being basically a construction project and a listed wrapper to being a major luxury hotel operator. So if you found this deep dive useful, if it helped you understand this complex story or maybe the wider Turkish hospitality sector a bit better, please do share it with others who might be following Mela or the industry.
And that leaves us with a really big long-term question, the one management will face the second that hotel opens its doors. Given that they've sunk $100 million into this asset, a cost massively inflated by hyperinflation, financed largely by high-cost internal equity from the parent, how are they going to ensure this brand new hotel generates returns high enough to actually satisfy that very demanding, very real cost of capital? Answering that question successfully will determine the ultimate long-term success or failure of this incredibly bold corporate bet.